Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, the ultimate in real estate is being the bank. And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
How many of you guys today would like to learn how you can become your own bank? Right? Probably every single one of you. That's why you're here. We're here to learn how to become our own bank. It's a very easy concept, very easy strategy. It's been used for 200 years, actually. It's been used by the wealthiest families in history. This is not a new concept. This has been around for a while. And today, we're going to spend the next 30, 45 minutes diving into why you should become your own bank and how you can. So first thing I want to start with is the idea of being the bank. If you owned a bank, would you guys make deposits in your bank or in somebody else's bank? What about Bank of America or Wells Fargo? Right? You'd probably try and store cash in your bank. Right? Why wouldn't you? No reason not to. And if you did store money in your bank, what if you needed a loan for a car or a house or a rehab on a deal or something? Would you go to your bank and borrow the money or somebody else's? Yours, right? And if you did borrow from your bank, would you pay your bank back with principal and interest? Heck yeah, you would. You wouldn't steal from your bank, just like you wouldn't steal from your business or yourself. So why don't every single one of you on here today, those of you who are new, why haven't you been taught how you can become your own bank? Why aren't you guys on here? Or why aren't any of you guys on here your own bank yet? I know a few of you already are, so we'll appreciate your guys' expertise in the comments. But a lot of you aren't, so why not? Again, this has been used and done for a very long time, so why haven't we done it in the typical consumer world? Well, let's change slides here. I'm going to start with explaining to you guys how this was used in the very beginning. Who used this in the very beginning? And you guys all know these names. They were household names, named like the the Rothschilds and the Rockefellers. Names like the Krocs. You guys know Mr. Ray Kroc? Do you guys know what business Ray Kroc started? McDonald's. And do you guys know what business McDonald's is in? They're in the business of real estate. They're not in the business of flipping burgers. They're in the business of building a large, efficient corporation that owns a lot of real estate. And how did they start that business? And what about Mr. Walt Disney? Disneyland, Disney World. Who and how was this business started? Through this strategy. What about Mr. Jim Harbaugh? You guys know Jim Harbaugh. He's the head coach of the Los Angeles Chargers today. He was the head coach of the University of Michigan a few years back, and the football team, sorry, I should say. And he utilized this strategy in his contract to ensure not just himself, but his family was wealthy and set off forever. He built generational wealth through this strategy last year, a few years ago, and many others are doing it today too. So how can we implement this as well? First off, those of you who are new, I want to give you a brief intro. Over the past 3 years, I've met with over 3,000 families across the country teaching this wealth building concept. And this has allowed my wife and I, Anna, to go travel the world, buy a lot of real estate, and built really a strong foundation to build not just wealth for today, but generational. And my story is pretty simple. I'm actually sure a lot of you can relate to it, no matter where you're from or where you're calling in, what your life experience has been. We've all had mistakes when we were young. We all did stupid stuff. We've all done probably some amazing stuff too. And one of those things for me was when I was 18 years old, I went and served a church mission and lived for a year teaching people and serving people in the country of Georgia, actually. And when I came home, I was in college and I had a lot of outside influences pushing me different directions. And one hand in one world, I was around the path. I was going to go to the corporate America world. I was going to be in the finance program and go into that sector of the industry. But on the other hand, I held real estate investing, entrepreneurship. I was around business owners and I saw the opportunity, the lifestyle, the freedom, the control that these guys had and women. And it changed my mind. But I still was battling back and forth between what path to take. And this eventually brought so much tension that I had to choose. And that decision I made to drop out of school and pursue an education in investing and learning how to make money work for me completely changed the course of my life. But above all, what's most important to me is my young family. And I'm sure you guys, what's most important to you guys too is the closest people and the relationships around you. So this whole strategy today is going to be all about you guys and how you can spend more time with those people that you love or do the fun things that you guys love to do. So when I was learning about this strategy, it was my first time getting into it. And well, I shouldn't even say that. It was something new that I was learning when I was studying money and educating myself on investing. And a question kept popping up. And this question was, could it be possible that there are more efficient environments to store money or wealth outside of the commercial banks in that system that we're not aware of? Is it possible that maybe, just maybe, there's better places to store money that we're not aware of? And really think about that for a second. I don't think you guys will ever get to a point in your life where you'll know everything about money. Neither will I, as much as I'd like to. But this is a powerful question because it's going to make you start thinking about what you're not already thinking about, what you haven't yet been taught to think about, what you might not know about when it comes to money. We need to be having a humble and kind of a learner mentality throughout our life around money. And you guys, I'm sure you've read books like Rich Dad Poor Dad, Money Master the Game, Richest Man in Babylon, these amazing business books. What do they all teach? They all teach to save at least 10% of your income. How many of you guys are doing that right now? 10%. Bet you most of you aren't. Most people in America aren't. Shane, you're a beast, man. I'm glad you are. I hope everyone in here can do that soon. Because without saving 10% of your income, you're not going to go anywhere, to put it bluntly. But in our American culture, we don't value savings. It's never been something we value, at least as of the past 5-10 years or so. I don't know why, but I think I have an idea why. We don't value the retention or the control of our dollars. And I think the reason is because the environments that we're actually told to put that savings are so incredibly inefficient and makes it hard for us to want to store money in those places. Environments like savings accounts, high yield accounts, 401ks, CDs. These places are inefficient and difficult for us to want to store money. But what if there was a way to store money in more efficient environments? That's exactly what today's going to be about, guys. And what today's about is about banking. It's about the money movement in your life. If you look up what banking means, banking is the business of protecting money. So right now, when you guys have a bank account set up somewhere else, you do all your banking with somebody else, guess what you're doing? You are giving up the opportunity to protect your money. Somebody else now is in the business of protecting your money. What about the verb form? The act of banking is the act of protecting money, the act of depositing money and lending money, the movement of money. It's all flowing. It has to flow somewhere. Why don't you control where it's flowing? If the other banking and the traditional banking organizations are the ones doing all of this, then they're at the center of it, collecting and making profit. Why can't we do that? Well, we can. You just haven't been taught how to do so. And so the interesting thing about banking is that it affects actually every single component of your life, whether you knew that or not. So throughout this presentation, I need you guys to have an open mind. I need you to understand this because once you see the banking world and how it can actually complement your life, you'll never be able to look at money the same way again. So I told you guys that I was going to teach you today how you can become your own bank, right? How you can set up your own bank and use it to do those activities. Well, first I want to show you what your bank is and what the attributes of your bank are. And so I want to ask you guys, if you were to compare a traditional bank to your bank, what are the attributes of a traditional bank and what are the attributes you'd want your bank to have? Again, I'll ask you guys in the chat. Miss Kathleen, thank you for joining from Denver. Those of you who are hopping on a few minutes late, we welcome you. We're excited to have you today. Thank you for spending your afternoon with us. You were at the very beginning here, so you're good. You didn't miss much. But guys, in the chat, let us know. What would you want your bank, the place you stored your money, to be? What are the attributes of your bank you'd want to have? I'll give you a hint on the first one, liquidity. Guys, who wants to store money somewhere that is not liquid? Right? Everyone needs liquidity. Liquidity is number one. And that's really all that a traditional bank offers is just liquidity. You put money in your Wells Fargo savings account and whoop-de-doo, it's liquid, but that's it. Maybe it's earning a tiny percent. And the actual growth rate on traditional savings accounts in today's market is 0.07%. So maybe your bank's making that. What if your bank had consistent returns? I know somebody in the comments mentioned consistent returns. What if you were going to earn 2, 3, 4, 5, 6, 7%? What if I told you it was, I'm going to use some big words here. What if it was guaranteed, so consistent? What if it was uninterrupted, so it was never going to be interrupted, never going to stop growing, and it was going to be compounding interest? That's pretty cool. So I'm going to get a bank that's liquid, but also earns interest at the same time. Awesome, right? That's something we'd want. Nobody mentioned this in the comments, but what about taxes? What if it was tax-free? Everyone hates taxes. No one wants to pay Uncle Sam more. Your bank, when you earn 0.07%, it's taxed, guys. What if your bank was tax-free? And what if it was protected? Somebody did mention security. Bingo. Protection is key. What if anytime, say you're a business owner, say you own rental properties, whatever the situation is, if you were ever in a lawsuit, judgment, lien, in some states, bankruptcy and divorce, what if this was a protected asset class? That provides some power. Last thing I'll add is stability. In 2009, guys, 364 banks went bankrupt. What if your bank did not and never has and never will? Powerful, okay? These are some attributes of a place you could comfortably store money. The benefits you get in storing your money in your bank would be astronomical. Just by looking at this list, your life would change. Now, wouldn't this be a more efficient place to store your money? This would be a place you could count on, you could control, you could use as the foundation to finance everything throughout your life. And I understand the chaos of trying to manage money. You guys all have lives, you have businesses, you got families, you got limited time and resources. So the opportunity you would get here to actually store your money somewhere that was going to have all these benefits, you never ever have to worry about it. You have peace of mind. You have risk-free from the market, from the world, from the economy, from the president. Nothing's going to be affected. You can sleep good at night forever. And to add to that, what if you wanted to take the liquidity out? What if you took money out of your bank and actually the bank did not stop paying you interest? Geez, where do you get that option? Right, that's pretty cool. Now that's something everybody in America should be diving deeper into. Wouldn't you guys agree? Say yes in the chat. Wouldn't you guys agree, or no if you don't agree, that if you could store your money in a place like this, that did all of this, that you would, right? And it's funny because this stuff is right under our nose every single day. It's just not often taught. So let's get into what your bank actually is. I'll just spoil it. I'll tell you what this is. I like to call it a vehicle because it's a place your money runs through. If that makes sense. It's not a thing where you're gonna put money and let it sit and do nothing with it, because that's not banking. Banking's moving money. We want to be a bank, so we want to be constantly moving money through this vehicle. So before I share with you guys what this vehicle is, I do want to share with you guys a quote by Mr. Will Rogers that said, "The problem in America isn't so much what people don't know, it's what people think they know. That just ain't so." So guys, don't judge this when I tell you this. I bet you guys are going to laugh and you're going to love this when I share it with you actually. You guys ready? The vehicle we use is none other than a dividend-paying whole life insurance policy from a mutual company. Who thought that was coming, guys? Who thought we were going to be talking about life insurance today? I'm sure some of you actually, if you guys were, watching Chris Naugle's content and led you to today, or maybe saw an ad. But this is important. This is not regular life insurance. This is not the life insurance you get from the insurance broker down the street or your broke brother-in-law that sells life insurance. This is the life insurance that's specially designed and engineered. And a lot of people have questions at first because they've been indoctrinated into the traditional way of thinking. They hear Dave Ramsey saying life insurance sucks. It's stupid. It's a waste of money. Buy a term and invest the difference, right? Well, honestly, I'll agree with them. If you put money in a regular life insurance policy, expecting it to do what I'm about to show you you can do with a specially designed policy, I'd be upset too. But this is specially designed and engineered. And Billy, I love that you've done research on this. That means you're going to be able to provide a lot of answers to the questions at the end. And I hope that this gives you guys a deeper understanding of what this is. So this being a specially designed policy, I compare it to a car. You guys all have seen a Ford Focus on the street at some point, whether you knew it was or not, just a basic car, nothing crazy. But what gets me super excited about this is when you look at a Ford Focus, that's a racing car. You guys ever seen Mr. Ken Block on YouTube? He will drive this Ford Focus. It's the exact same car as this one. Nothing different but the design and engineering. Okay? Exact same car, just different design. So the policy is the same thing. It is nothing like life insurance. It actually looks more like a supercharged bank account than really anything else. And many of you guys might know, many of you are probably not believing this quite yet. Many of you are, actually, it looks like. But remember a few minutes ago that I asked you guys, would you agree that if there was a place to put your money that had all of those benefits, that you would? Well, that's what specially designed whole life insurance is. That's how these policies work. You've either been sold the wrong thing in the past or you didn't know that this was possible. And when I first learned about this, I had a couple thoughts about it. I thought, well, it's got a low rate of return. It's not a good investment. It's expensive, is what I've heard. And maybe many of you might think that it's a worst investment of all time because I've heard that too. And I thought, well, I know a lot about whole life. It can't do that. I was told it had these things. It was a low rate of return. It wasn't good. And maybe you guys are thinking that life insurance can't work the way I'm showing you. Or is this real? Is this legit? Well, why would there be so much controversy around such a simple thing? Something has to be wrong. Well, if you guys are taking notes, which I encourage you to do, write this down. Only thing you need to write down the whole time if you don't get anything from this. Whole life insurance is not an investment. Guys, it has nothing to do with investing. It has nothing to do with investments. Whole life is considered an alternative asset class and a type of permanent life insurance. And if you read the fine print in the contract, it says everything's guaranteed. There's guaranteed growth, there's guaranteed death benefits, there's guaranteed cash value. It's guaranteed to have your payments never increase. So how is that an investment? There's zero risk. So if you could take anything from today, know that it's that. And as soon as you hear somebody, or maybe you'll go home, talk to a friend, a family member, a spouse, a business partner, and tell them you're going to do this whole life banking thing. And if they tell you, don't do that whole life thing, it's got a low rate of return, it's actually a bad investment, I can get better returns elsewhere. You now know that person has no idea what they're talking about because they can't even correctly identify what type of asset class that is, right? You cannot get a policy built like this from just a regular insurance agent and financial advisor. Also why it's not super common. You can only get policies like this from banking professionals, which is what we are. We're here to teach banking the right way. The way it's been done for so long, we've just strayed from it. So if we're going to do what wealthy people do, just like those books in the beginning I mentioned teach us, and we want to be our own bank, then let's just mimic what banks do. And there's actually a great book about this called Becoming Your Own Banker. Every single one of you on here today need to buy this right now. It's on Amazon for $20 probably. It's cheap, it's easy, it's a short read. This will change your perspective. This is what changed my perspective. And what he talks about in this book is the problem that we have is that in America, or even the world, we finance everything. Now, what does that mean and why is that bad? Well, we finance everything we do. It means you either borrow money and pay interest to somebody else, which a lot of us use other banks to do that. Or like other Americans, we've been taught to save that money, build the account up, and then buy cash and deplete our savings. Either way, there's an interest cost. You're giving up the interest that you could have earned on that money. Whether you pay more interest by getting a loan, or you build up the account making the bank interest and you not earning anything, then you give it all up anyways, and you lost the ability to save that money or grow on that money or build wealth with that money ever again. So the problem is we finance all of the things in our life with other banking organizations, other people. We've been taught to get into business or to invest, but all we're doing is just giving the bankers more money, giving them more control over what we're doing. This is why we need to become our own bank, so you can be in control of these transactions, so you can be the one earning interest always. And if you look this up, actually, BOLI, bank-owned life insurance, you will find that banks really do this. These 4 banks alone, all banks you guys know of, they have over $70 billion with a B in whole life insurance. Guys, not index universal life insurance, not ULs, not VULs, not universal life, not term insurance, whole life. But everyone tells you whole life's the worst one. Why? This is what they're actually buying. Is it just the best kept secret? Is that what it is? Guys, banks are actually the #1 purchasers of these whole life policies in the world. Not only do they keep buying more every single year, they actually own more whole life than they own in land and buildings combined. And think about how much real estate these companies own, right? They own more whole life. So you guys need to ask yourself, are banks just stupid? Or do they know something that we don't know? Right? They're genius. They know what they're doing. They make money on us every year. They know what they're doing. And you know what? Here's actually how banks work. I'll give you a little illustration so you can kind of see how this works. So what if you had money and you wanted to deposit it into a bank? We all have money that we all deposit into a bank, whether it's $100, $100,000, $100, whatever it is. And let's say your bank is awesome and they pay you 4%. It's a high yield account. They're crushing it. They pay you 4%. You're stoked, right? Well, what does the bank do once this money hits them, hits their accounts? Once you put your money in your savings, it goes to them, they immediately go lend it out. They go invest it. They'll lend it to somebody buying a house at 7%. So they're going to make a little spread on you there. And then what is the home buyer going to do at closing in the bank? They're all going to go to escrow. They're going to pay the seller. And where's the seller going to put the money in the end? Back in the banks, right? Well, where's the bank going to put it next? Well, they'll lend it to somebody else. Maybe someone wants a car note. He'll lend them there. So maybe there's a car note next at 8%. So the bank's making a spread there too. Who's going to pay the car dealership? Who's going to put the money back in? Is probably going to lend it to someone else who needs a home remodel loan. Who will pay the contractor? He'll put the money back in. Once that's said and done, maybe the contractor has some debt they need to pay off. They'll get a debt consolidation loan. They'll pay off their credit cards and they'll go refill the bank. Guys, I know a lot of you may have heard this before and a lot of you haven't. So who do you want to be in this situation? The person who deposited the 100 grand and the bank then used? The person buying the house? The car dealership maybe? No. You want to be in the business of banking so that you can control all of these transactions. You want to be the bank in the middle. While you're making 4% and they're making 7%, they're making a 3% spread. They're making a 4% spread on you on the car. They're making a 5% spread on the home remodel. They're making an 8% spread on the debt consolidation loan. You total all of those up, they're making 20% while you're making 4%. And I just gave you a little spoiler, but how much does 4% go into 20%? 5 times. So they're going to make 5 times more than you are. That is a 500% return on your money every single year. That's what the banks are doing. They're the one profiting. Why don't we do that? You can actually look it up. You'll read that banks make between 400 and 1,300% each and every year. Pretty cool. Right? Good for them. How can we do that though? Last thing I want to share with you guys before we dive into some real numbers and show you how this works is one more little story. And it's going to highlight the importance of uninterrupted interest, compounding growth, right? How many of you guys have ever heard the riddle, would you guys rather have $1 million today or a penny that doubles every single day for the next 30 days? Let's liven up the chat again, guys. What do you think? We got more people in the meeting now. Welcome those new people. Do you guys want the $1 million today or the penny that doubles every day for 30 days? You guys are smart. You guys know you want the penny. Good call. I'll show you the math though. So on day 1, your penny would be just a penny. On day 2, it would be 2. It would then be 4, 8, 16, 32, 64, 128, 256. Day 15, it's 160. Day 16, it's $300. Then it keeps doubling to day 30 when it gets to 5.3 million. Heck yeah, I'm taking the penny that doubles every day, right? And if it's a 31-day month, we're gonna get that puppy to 10 mil. All right, let's do that. But on day 1, some people would have taken the million. This is the power and importance of compounding interest. I'm gonna add an example here though. What if while your penny was compounding and doubling every day, there was a fee attached to it? What if there's a 2% fee? Would you still take the $1 million today? Or the penny that doubles every day for 30 days, but with a little fee attached to it? Well, after 30 days, it grows to 2.9. So you still would want the compounding interest despite a fee, right? What about if well, actually I should highlight. Think about that. After 30 days, you would have had 5.3 million, but you lose over $2 million of compounding interest because of a 2% fee. Is 2% of 5.3 million 2.9? No. Why is there 2.9 left? You lose so much interest though because of the fee. Sure, it's better than the $1 million up front, but compared to no fee, 2% fee makes a massive difference on the compounding. What if there was a withdrawal? What if on the 15th day and the 25th day, you chose to pull money out? You took $100 out, just $100, okay? $100 is not a lot, but look how much it ends up growing to in the end. Only $2 million at the end, all because of $200 of withdrawals. That is stupid. By $200 of withdrawals, your compounding only gets to $2 million. You lose out on over $3 million of compounding because of a stupid $200 withdrawal. What if you took a loan for $100 on the 15th day and a loan for $100 on the 25th day instead of a withdrawal? But debt's bad. I don't want debt. I've been told debt's not good. Well, your account would have ended up being $5 million. I'm sure you would have gladly taken a $100 loan instead of a withdrawal, right? Who wouldn't want that? And last example, what if there was a tax involved? 15% tax. That 15% tax is a lot more than you might be thinking. It only gets you to $500,000. So again, it could have been 5.3. It is only 500,000. How many of you guys would agree that some of the places we've been taught to put money have all three of these things going against your compounding growth? They all are going to charge a tax, whether it's now or later. Most places, almost every place has a fee, and 2% is not far off from the typical. And if you want to take money out, yeah, we'll let you. There's typically loan options too, but most of the time they'll let you withdraw. These are days I'm referring to. This is just an example out if you walked in late. In 30 days, if your penny doubled every day for 30 days, it would get to 5.3 million. But by these three things deterring from your growth, it gets nowhere near the amount. So is there a place that you could put money that actually had no taxes, no withdrawals, no fees, and it just uninterrupted compound interest your entire life? You guys got it? A specially designed whole life insurance policy. You guys here today are learning a secret to building wealth. What if a policy was the foundation? What if the compounding interest was the foundation of where your money was being kept? And then whenever you wanted money from this account, you took loans against it. That would be a lot more powerful. So now that we've laid the framework of the power of life insurance, the credibility behind life insurance, what banks do and how they operate, and why you'd want to become the bank, and now uninterrupted compound interest, you guys now understand that, right? Let's go put this into action. I'm going to show you guys how to buy a car and get all the money back for it. I'm going to show you guys how to buy a car through a policy, okay? So let's see. I see you guys in the chat. You got some questions. Let's see. Abby, when do you pay taxes on this account? Life insurance is a tax-free vehicle. You will never owe tax on any growth inside of the account. The death benefits are tax-free as well. So let's talk about this. On the right side here, I have a big screen or a chart showing you the policy and taking a loan and stuff. Don't dive too deep into it yet. I'm going to show you this in 2 seconds. Before I show you these numbers in this example, I want to share with you a couple of things that I think are important. When we're looking at life insurance, a lot of people look at the premium first and they say, I don't want a premium. A premium's a payment. It's an expense. I have so many bills. I can't add another. Wrong. This is not an expense. How many of you guys also say the same thing about a bank account? Do you guys say, I don't want to save money. I hate it. It's a bill. I'm forced to do it every month. I don't want to do it anymore. I've never heard that out of anybody's mouth. They want to think, or they want to say, how can I save as much money as humanly possible? How can I get my bank account to get bigger and bigger and bigger? It's not an expense. So if the money you store in the policy is available and liquid to you just like a bank, then why would you not want to deposit as much as humanly possible in it, right? So we need to change the way we look at premium. We need to think about it as a deposit. So from now on, I will try and call it a deposit to keep ingraining that in your guys' head because this is important. And a lot of you might be thinking that you need a lot of money to do this. Definitely not. My very first policy was $250 a month. I was just starting to slowly save some money. Just put a little bit away. This example I'm going to share with you is a guy who saved 10 grand a year. He made 100 grand a year. So he saved 10%, 10 grand a year, and he put it in his policy. You guys could do very similar things. I almost guarantee it. And some of you might be thinking, maybe you're too old to do this too. And possibly true, but really, I've set up policies on people who are babies, brand new babies, all the way up to people who are in their early 70s. You pretty much can do this at any age. It doesn't matter. If I put $1 into a policy, or my grandma puts $1 into a policy, it's still $1. Her dollar is not worth less because she has a larger number for her age. It's the same dollar. So the policy is the same. Does not matter your age. Does not at all. What will be different is your death benefit. A death benefit for her is going to be a lot smaller than a death benefit for me if we both put it in. But I'm not building this policy for a death benefit. I'm building this policy to be a bank. So the death benefit does not matter. And we're not building it for a death benefit. So that being said, let's share with you guys this example of using the policy to buy a car. Let's say you deposited $10,000 into the policy every year. And the cash value over here on the right side is what is liquid and available. So in year number 1, he puts in 10, has access to 6, okay? 5,800. Year 2, he puts in 10, he has access to 12. Year 3, he puts in 10, he has access to 4. Brutal, right? Why is it 4? It's because he actually took $25,000 out of the cash value to go buy a car cash. So again, 3 years in, he's put in $30K in premiums. He's taken out $25 as a loan against his cash value in his policy to go buy a car cash. If he's going to take a loan from himself to buy a car, shouldn't he pay himself back too? And what's a typical payment for 25 grand today's interest rates? Call it $500 a month for 60 months, 6 grand a year for 5 years. He's going to pay himself back like he would pay anybody else. Okay, so let's sum this up. Over 7 years, he's put in $70,000 in premiums. He's put in $30,000 to repay his loans. He's taken out $25 to actually buy the car, cash. And so really his net injection into this thing is 75 grand. That's what he put into it over 7 years is 75. And look at his cash value at the end of the day, 67,000. So wait, he put in 75 and has access to 67. That would mean he had access to 91% of the dollars he put into this. 91% of 75 is about 67. He had access to 91% of the money he put into the policy. So again, I told you guys you'd be able to get all the money back for the car. You don't at this point. You only really get back 91% on the car purchase. But let's keep going. And by the way, everybody listening here, we got a bunch of you who are new to this. If I'm going too fast or the numbers don't make sense, please stop me. Please throw your questions in the chat. This chat is meant to be more of a text chain. I want to be constantly communicating with you guys, understanding what you're thinking, what your questions are, so I can best help you guys understand this. So please let me know if this is making sense. But in year number 8, he chooses to keep having the policy, but he doesn't want to pay more into it. So he stops. No more contributions after the 7th year. He also needs a new car now for his 16-year-old daughter. So he buys another car for 25 grand, which he takes $25,000 as a loan from his cash value in that 8th year. He takes that loan, and what's he going to do? Pay himself back $500 a month, just like anybody else. So again, let's sum this up. He's put in $0 in premiums, $30,000 to repay the loans, and $25,000 he took out. So his net injection is $5,000. And Felicia, this might answer your question, Felicia. So during years 8 through 12, he put in 30, but he took out 25 to go buy a car. So really all he put in there was 5. In the first 7 years, he put in 100, but he took out 25. So really all he put in was 75. He put in 75 and had access to 67. In the next 5 years, he put in 5, and look at how much the cash value grew by. It went from 67 to 91 over those 5 years. So the cash value grew $23,000, and he put in just 5. He just made money off of buying that second car because he was the bank, because he financed it himself, because he paid himself interest. He just controlled the entire transaction. So look, over the whole 12-year period, he put in 75 in the first 7 years and 5,000 in the next 5 years. So he put in 80 grand. He has 91K in cash value, and he has 2 cars paid off sitting in the driveway. So yeah, he made money on buying 2 cars. How cool is that? Right? Pretty stinking cool. I hope that answered your question, by the way. There's 3 rules that I implement when I utilize this strategy. Number 1, I pay myself first. Number 2, I pay myself back with interest. Rule 3, I recycle and recapture my money. Because wouldn't you agree it'd be better to pay yourself the interest than pay somebody else, right? And Billy, you asked if I stop paying premiums after year 7, do you never have to pay into it again? Correct. You can design a policy where after 7 years, you never put in money to it ever again. And that doesn't mean you will stop earning in the policy, does not mean you'll stop compounding interest, does not mean you'll lose the death benefit, does not mean you'll lose the ability to take loans against this. Nothing changes. Felicia, you're correct. What you put into it was $100,000 in the first 7 years and $30,000 in the next 5 years. So you put in 130. So let's do that math. You put in 130, but you have 2 cars worth 50 grand. And 91 left over. So you put in 130, have 50K worth of cars and 91. 91 plus 50 is 141, and you put in 130. So however you do the math, Felicia, you still make money on buying 2 cars because you're the bank. So again, these were the 3 rules. So if this works for a car, then what else does this work for, guys? Everything. Guys, how many of you guys in the chat wish you knew this earlier in your life? How many of you guys wish that you did this the last time you bought a car? How about a house? Like Elise put in there. How about your next house? How are you going to buy your next house? How are you going to buy your next car? Or how are you going to pay Uncle Sam the next time you owe taxes? Who wants to be the next case study in these presentations, guys? You can do this too.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
Let's change it up and give you one more example. Show you a little chart here to show you how the money's really moving. So I know you showed you the chart down in a line of year to year, but this is how the money flows. We recommend setting up a segregated bank account. All that means is a separate checking account at your current bank, and the sole, alone, only purpose of this is just to know what's going in and out of your bank account and be organized. That's really it. To know what you're paying in premiums, to know what you're repaying in your loans and all that kind of stuff. So we're going to say, all right, well, what if you had a debt you wanted to pay off? No longer a car, but a debt. Let's say you owe $23,000 on a debt, on a line of credit, and you were owed 9% on that debt. Well, instead of taking your 23 grand, sitting in the bank and paying off the line of credit, which some people think is the best thing to do because then you pay it off, you no longer know interest, you paid it off cash, you're stoked, right? Which is good. It's better than keeping the debt, but there's, again, a better way to do it. What if I put in $30,000 into a policy, took $23,000 out as a loan, paid off my line of credit? Now I have my $30K in a policy, earning interest and dividends, compounding the rest of my life. I no longer lost the ability to compound interest on my money. That is saved, growing, earning for me the rest of my life. And I took a loan against that compounding money of 23 grand to pay off my line of credit. Again, remember, now I still have money growing and I have the debt paid off at the exact same time. And let's say your line of credit was $289 a month. Well, what are you going to do with that payment now that you no longer have to make it? Pay your policy back, right? Just recycle that payment. Pay yourself $289 a month. So if you're earning interest in the policy and you're paying yourself back 9% because that's what you were paying a line of credit, you're making money 2 times on your money and you have a death benefit while you do it. Mind blown, right? Heck yeah, I want to do this. Why don't every single one of you be financing your debt, your purchases, your investments through a policy? There's no reason that you don't. Every single thing you can finance through this strategy. What if it was an investment? What if instead of a debt, they were going to pay you 12%? Now you can use the income to refill the policy and it only gets better from there. That's the stage that I'm at. No debt, no purchases. I buy real estate. I buy rental properties in large packages all over the southeast part of the country. And even in today's market, I'm a little hesitant, but I'm still buying more. And all my cash flow from these deals, refill my policies, then I go buy more of them. I just rinse and repeat the same money to go build myself wealth in real estate and in life insurance. So guys, two things are going to happen to us in our life. We're all going to live and we're all going to die. Are we better off with this than without? Guys, I just showed you multiple reasons why you're better off with this than why you're not. What about when you pass away? We're all going to pass away. It's proof, or it's not proof, it's guaranteed. Are our families better off with this than without? They're going to get a large lump sum paid to them because of the death benefit. I know we don't talk a lot about it, but it's very important. And that's going to help your family. So yes, you are better off with this than without, and so is your family. Don't you guys wish you knew this when you were my age? Don't you wish you knew this well, don't you wish your kids would learn this from you? Maybe if they're young adults now or adults now, how can you teach them to incorporate this while they're still young and have time on their side? Or you guys too. Don't you wish you guys and your parents started this for you when you were young? This is a family conversation, a family banking system that we are setting up. Guys, we covered a lot today, and I promised I would share some important stuff with you. To highlight what those things were is that banks profit by leveraging your money. Just flip the dang script. Be your own bank. You don't need to be rich to do this. Anyone can do this with the right tools and the right team helping them. With inflation and market uncertainty, family banking gives you the total, ultimate, complete control. If you guys want to have certainty in your life, some sort of certainty, because life's crazy, and control from here on out, then you need to make the decision today to set up your own family banking policy. It's a must. Guys, I really appreciate your time today. I'm going to end here with question and answers and a couple of last thoughts. But I and our team are dedicated to teaching this strategy to you. We do it completely for free. There's no $5,000, $10,000 setup fee for you to do this, guys. This is free. I'm handing this to you. You can set up a policy with us. We will go to the insurance companies with you, handhold you to show you how to set it up, structure the policy correctly, and then help you use it. We will educate you so you know how to use it. We are paid from insurance companies. I'm not doing this for free, of course. I got to make money somehow. But I get paid from insurance companies. So I get paid from them for the business that I keep bringing them. And because of that, they then will build these policies for you guys free. No cost, no fees, no setup percentages. It's just you storing money in your own life insurance policies and you using it to be the bank. And that is it. So this is my email here on the page. If you guys would like more resources, more videos, presentations, examples, I'd love to share with you whatever more research you'd like to do. I have all kinds of stuff I can send you. Putting my email in the chat right now. Those of you who are like, yes, I need to set this up. I might not know everything about this, but I need to learn it. I would recommend to set up time to meet with me. We can do a 30, 45-minute free consultation. Go through your whole financial situation, your plans, your goals, your vision, and show you how you can implement this strategy yourself. It's very simple, very easy to do. The family banking system is right for everyone in the country. Anyone who saves money and has financial goals, I would say. People who don't have any goals or drive shouldn't do this, but they shouldn't do most things. Most of you on here, well, not most of you, all of you on here, because you took action to be on this presentation, I can almost guarantee every single one of you are ready to set something like this up. I will end here with question and answers, like I mentioned. If you would like to meet, that link right there through in the chat will send you directly to my calendar. And as we wrap up, guys, what questions do you got? What didn't make sense? What slides do you want me to look back over? How else can I help? William asked a question, is this the way to get past the 1099? Not totally sure what you mean, William. Maybe clarify. Company names. Our company name is the Money Multiplier, and we are a brokerage that works with many insurance carriers. So any mutually owned company that's been around for 100 plus years, we probably work with them. So big name insurance carriers. Can you use the money growth from interest to help pay for your monthly premiums? Totally, man. You could. So actually, you know what? By money growth interest, do you mean the growth inside of the policy? Or do you mean lending money out and creating a return and using that income to pay the premiums? I guess either way, the answer is yes. You could use both forms of income to pay premiums. It's just on a policy. You're not going to have enough dividends to pay your premiums probably for many years. But eventually, you definitely can do that. And then, yeah, if you have income from investments that you want to use that to pay premiums, go for it. Great idea. Marie, you want a little replay? I got you. I got you. I will, where is that link? Let's stop sharing. Let me send you this link. So, yes, replay. This is a family conversation, guys. I would be showing this and watching this on the TV with your spouses, your kids, your friends, your co-workers. This is something you guys can do together and should do together along with all other financial activities, to be honest. How do you fund multiple policies? You don't need multiple policies, to be honest with you, man. You only need multiple policies if you have too much money, you don't know where to put it. So if you're in that position, awesome. It's a great problem to have. But let's say the policy you're putting into it 10 grand a year, then you would just put 10 grand a year into it. And if you at some point you got a raise or you have less expenses and you're saving now 20 grand a year, then you would keep your first 10 grand a year policy and set up a second policy for another 10 grand a year. That way you have two policies. So you only add policies as income increases or as you have more cash flow or as you want to insure other family members like kids, spouses, friends, not friends, or parents, siblings, and you want to insure other people, then maybe it makes sense to add more policies. Miss Abby, can you convert an old term policy? No, you cannot. Because the only thing you can convert in life insurance is the cash value. And term insurance has no cash value. It's just a payment that you're giving away. So there's nothing to convert anyways. Crystal said, you showed an example of putting in $25,000 into the policy, but then the cash value is much less than what you put in. So how is it that you can take out a loan for more than what your cash value currently is? Great question. You can't. The only thing you have access to is the cash. That's what's liquid. And in the first couple of years of the policy, your cash value will be less than what you paid into it. But eventually, because of the dividends, because of the growth, you will have access to more than what you're putting into the policy over time. Hence the compounding interest. It just takes time for the policy to build. So in year number 1, year number 2, you're gonna have access to less than what you're putting in. So it wasn't wrong. You really won't have access to every single dollar for a couple of years. And that's because you're paying for the benefits of what the policy offers you, like we discussed in the very beginning, and you're paying for the death benefit. It is still life insurance. We're just now leveraging life insurance as a tool to store money. Can you fund a policy from an IRA or other qualified plan like a 401k? Mr. Miles, no, you cannot. I guess, yes, you could, but you have to pull it out of the qualified plan, pay the taxes and penalties, and then put it into a policy. So most of the time that doesn't make sense. There are some times in which it does. Some people want the money out of the market. It's an old 401k and they want to roll it into real estate. Then yeah, let's run it into a policy and go buy real estate with it. Totally makes more sense than leaving it in the account. But there has to be a reason for you to want to get rid of that account for it to make sense. Can you transfer your current whole life policy with Primerica? Yes, you could. Depending on how old it is, how much is in there, what the payment is, maybe we recommend to get rid of it. Maybe we recommend to roll it over. Maybe we recommend to keep it and get another one. So, Monica, that's a great question. Probably more of a case-by-case situation. We should set up time to meet to go through that specifically. And if you guys do want to meet to go through the strategy more in depth for you and ask more questions, there's my calendar link. After the initial dump in, can you do more later on? Janelle said. Yes, you pay into the policy every year forever. You have options to stop it at certain points, but yes, you're going to fund it forever, not just the first year. All right, guys, we're about to hit the hour mark. The last couple questions from anybody, then we're good to go. Again, if you just want more resources sent to you, you want more podcasts, more examples, please email me and I'll send those resources to you at carson@chrisnaugle.com. I just threw it in the chat again. If you would like to meet to discuss this concept further for you, the website is carson.beyourownbanker.com. I just threw that in the chat as well. Last question, how long in time after opening a policy before you can say, get a car? Depends how expensive you want a car. You want a car for 20 grand, put in 20 grand. Then wait a couple of years, or put in 30 grand and pull out 20. So it just depends on how much you need. If you want to go buy a house for 500 grand, you need to have put in over 500 grand into it. So this is not a get rich quick scheme. This is not a build wealth today. This is a long-term strategy to build a strong foundation financially that will result in a very strong wealth building tool, you could just call it. So if your goal is to buy something or pay off debts, you start where you're at, you start saving what you can, and then we start one step at a time. Maybe we use the policy at first to pay off some small credit cards. Then we pay off a car. Then we pay off the house. Then maybe we buy a new car. Then maybe we buy a rental property. All of these things in succession will happen through the policy. This policy is just the reservoir of all your capital goes first, and then you leverage it out to go make it work for you. And yes, you can transfer a regular whole life policy, Melanie, but it depends on the policy, depends how it's structured, depends how much is in there. So it'd be best for us to just meet and discuss that one-on-one, because a lot of depends, as you can tell. Alrighty, guys, top of the hour. Thank you guys for joining. This has been fantastic. Great to meet all of you virtually. Please attend every single webinar you can and keep learning this as much as you possibly can. And yes, I can do a one-on-one with your kids. Honestly, Abby, I would send them this presentation because this teaches the concept. A one-on-one call with a 20-year-old is going to be very difficult to teach them the strategy. Most 20-year-olds don't understand money. So I would send them this presentation because it's a very deep dive into the concept. And then let's set up time for all of us to meet together. If you want to send them the presentation, there you go. All right, guys. Thank you guys so much. We'll see you soon.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.